Good day, investors. In this video, we will take a closer look at Equinor, ticker symbol EQNR. The company just released its Q1 earnings, and despite the volatility across global energy markets, the company delivered a very solid quarter. Production increased 9% year over year, and adjusted operating income came in at nearly $10 billion. At the same time, Equinor is still benefiting from strong oil and gas prices and increasing global energy demand. So in this video, we'll break down the latest earnings results and fundamentals for the company. Then we'll look at the valuation. And finally, I'll give you my personal take on whether Equinor stock looks like a buying opportunity right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe for more upcoming investing videos. Thank you very much. So let's start with some of the key highlights from the quarter. Equinor delivered a very strong Q1 despite volatility across global energy markets. Oil and gas production increased 9% year over year, driven by strong operational performance and new projects coming online. The company also benefited from relatively strong oil and gas prices during the quarter, and management highlighted that trading operations helped capture additional value from market volatility. As a result, adjusted operating income came in at nearly $9.8 billion, while net income reached approximately $3.1 billion. Equinor also generated around $6 billion in cash flow from operations after tax, which continues to support strong shareholder returns. The company announced a quarterly dividend of 39 cents per share, along with another share buyback tranche worth up to $375 million. So overall, this was a strong quarter with solid production growth, strong profitability, healthy cash flow generation, and continued capital returns to shareholders. Now, one of the biggest drivers behind the strong quarter was clearly production growth. As you can see here, Equinor increased oil and gas production by 9% year over year, which is a very strong number for a company of this size. Management highlighted strong operational performance in Norway, along with new projects coming online, including Johan Castberg, Halten East, and Verdande. The company also reported record high production in the United States during the quarter, while international production also increased, supported by assets like Adura and Bacalhau. And on the renewable side of the business, power generation remained relatively stable, supported by Dogger Bank and new onshore renewable assets. So overall, production growth continues to be a major strength for Equinor right now, especially with multiple new projects continuing to ramp up production levels going forward. Now, after looking at the production growth, let's take a closer look at the financial results for the quarter. The Norway business remained the strongest contributor, where Equinor delivered strong production growth of 10%, along with high realized oil and gas prices. The company also reported record high production in the United States, which benefited from stronger natural gas prices during the quarter. Another major strength was trading, with management highlighting strong performance in both products and U.S. gas trading. As a result, group-adjusted operating income came in at nearly $9.8 billion, up from around $8.6 billion during the same quarter last year, which shows the company continues generating very strong earnings and cash flow while benefiting from solid energy prices. Now moving to cash flow, we can see that Equinor continues generating very strong amounts of cash. The company reported more than $10 billion in cash flow from operations during the quarter. And even after taxes, cash flow from operations still came in at around $6 billion, which is very strong and continues to support shareholder returns and future investments. Equinor also invested around $3 billion into organic capital expenditures during the quarter. While still maintaining a very strong balance sheet, the company ended the quarter with around $20 billion in cash and financial investments, and the net debt ratio declined to just 15.3%, which remains a very healthy level for a large energy company. At the same time, Equinor returned approximately $1.2 billion back to shareholders through dividends and buybacks. So overall, the company continues generating strong free cash flow while maintaining a healthy balance sheet and paying significant dividends to shareholders. Now looking ahead, management continues to sound confident about the outlook for 2026. Equinor expects oil and gas production growth of around 3% for the full year, supported by new projects continuing to ramp up production. The company also plans to invest around $13 billion into organic capital expenditures this year. While still returning large amounts of capital back to shareholders, Equinor maintained its quarterly dividend of 39 cents per share and expects total share buybacks of around $1.5 billion during 2026. So overall, management continues focusing on balancing production growth, shareholder returns, and long-term investments across the business, positioning the company well going forward. Now, after looking at the earnings figures and guidance, it's important to understand where the company's long-term growth is expected to come from. As you can see here, Equinor continues projecting strong long-term production and cash flow growth through 2035. With management targeting around 1.2 million barrels of equity production per day by 2035, a major part of this growth is expected to come from the Norwegian continental shelf, where Equinor continues expanding production hubs and developing new projects. The company also highlighted a large portfolio of future development and exploration opportunities, while continuing to focus on cost discipline and operational efficiency. At the same time, management expects the business to continue generating strong, long-term cash flow going forward. And when we look at the Norwegian continental shelf opportunity, we can see that Equinor continues building a very large long-term development pipeline. Management highlighted more than 500 future opportunities identified across the portfolio, including around 69 fields and more than 65 discoveries, along with hundreds of additional recovery projects and exploration prospects, which gives the company a very large inventory of future development opportunities and supports strong long-term production growth potential for Equinor. So after looking at the growth drivers and long-term opportunities for the company, let's now take a look at the valuation and analyst expectations for the stock. According to stock analysis data, the one analyst currently covering the stock has a price target of around $37 per share, which is slightly below the current stock price, indicating relatively limited short-term upside expectations at current levels. And the current analyst rating on the stock is hold, suggesting the stock is viewed as fairly valued right now. And when we look at the stock performance, we can get a better view of the current setup for the stock. As you can see here, Equinor stock is currently trading around $38 per share, giving the company a market capitalization of roughly $103 billion. The stock currently trades at a forward PE ratio of under 8, which is still relatively low compared to many companies across the broader market. Equinor also pays a dividend yield of over 3%, making the stock attractive for many dividend and income-focused investors. And over the past year, the stock has performed very well, with shares rising more than 60% over the last 12 months. However, we can also see the stock down around 8% today following earnings, potentially creating a more attractive buying opportunity at a lower valuation level. So when we bring everything together, Equinor delivered a very strong quarter with record production and solid financial performance. The company produced over 2.3 million barrels per day during the quarter, up 9% year over year, and the highest production level in company history. While net income reached around $3.1 billion, management also maintained full-year guidance, still expecting around 3% production growth for 2026, along with approximately $13 billion in organic capital expenditures. And if oil and gas prices remain elevated, cash flow could improve significantly versus prior expectations. At the same time, shareholder returns remain strong, with a quarterly dividend of 39 cents per share and continued share buybacks. So in my opinion, Equinor continues looking like a financially strong energy company with solid production growth, strong cash flow generation, and an attractive dividend yield. And after today's pullback in the stock price, I think this could be an attractive opportunity to buy the dip on Equinor. As the dividend profile remains very strong, the cash generation continues to look excellent, and the valuation still appears relatively reasonable compared to many other large companies across the market. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.